Okay, guys, we're going to go to Ask Scruff. Now, this one's for Cliff. Salute to you, my kid. So let's flick the chart over and we'll have a quick look at it. Looks like there's a bit to unpack, but it's not as difficult as it sounds. Just clarify how you descender considering stop size when scalping. If you decided to scalp for 7 or 8 pips, would you consider doing Scruffy Madness? Yes, do Scruffy Madness on everything. I know you like to see 2 barriers between entry point and stop, but when scalping it may be difficult due to the small number of pips of target of entry and Scruffy Madness could set up. But the box of pain behind 2 barriers could be a distance away, etc. I know you like to be in and out. Hope it makes sense. Don't need to apologize. Really, it is in the way the scruff under stops. Let me kind of clarify. I break the trade up into elements. So the stop essentially has one job. It's not part of the trade. When you talk about risk reward and all of this, what happens is you would then start forcing the trade because you go, oh, well, the scalp's 10 pips. So therefore, I've got to have a 5 pip stop to make certain I've got 2 to 1. Well, all that happens is the market takes you out of the equation. Just wipes you out. So you've got to apply a bit of common sense. And you look at, is there a strong directional drive in the direction you want to go? In other words, is all of the momentum in your favor? If it is, you've got a high probability setup. Okay. Now, if you're going for 7 or 8 pips, that's not a problem. Now, if you scroll it back into a 15-minute chart, you've actually pulled all of the swing points in as well, because a swing point on an hourly or a 4-hourly chart can be miles away, yet on a 15-minute, it's actually tightened in. So you can go, right, okay, I don't really want it to go past said swing point. And regardless of what you're doing, this should be a solid level kicking around somewhere. So that'll give you a distance. Now, once you've got that distance, you can ask yourself, I know I'm roughly getting in at X point. How far is that? Well, if it's 20 or 30 pips, fine, it's 20 or 30 pips. And you might be thinking, oh, hold on, I'm only getting 10. Yeah, but the markets do move against you on a regular basis. And I work from the 3rd position. So what I would do is I would make certain from position 3 or position 2 to target is equal to what the stop is. So therefore I work on a one-on-one. So that's how I do it. And I always separate them. And what I mean by that is I don't put the stop into the trade equation at all. It's just that's where the stop has to be. That's how much it's going to cost, and do I agree to it? If I do, I'm happy. That's the end of the stops participation. Then what I have to do is look for a good area to get in. If it runs straight to target, amazing. But I always assume it's going to step back on me because history tells me that, which means as it goes backwards, it naturally reduces exposure, even on a scalp. So it'll reduce the exposure. And because it's stepped backwards, it's now going to move further to get to target. It increases the upside as well. So it actually cancels everything out. So it's all part of a trade makeup, but you just tighten it up on a 15-minute chart. Hope that helps. Catch you soon.